This is Simplify High Yield plus Credit Hedge ETF, ticker symbol CDX. In this video, we'll discuss what is CDX, why is hedging high yield important, how is CDX managed, and portfolio use cases. CDX seeks to maximize current income by investing primarily in high-yield bonds while mitigating credit risk. In other words, CDX is a credit-hedged high-yield bond fund. First, why consider high-yield bonds? High-yield bonds can be an attractive asset class, having more than doubled the returns of investment-grade bonds since 2000. This additional return was earned in exchange for accepting a greater degree of volatility and drawdowns inherent in bonds with below investment-grade credit quality. Mitigating this risk is why hedging can be important. This chart displays high-yield credit spreads since 2007. It represents how much high-yield bonds are yielding above U.S. Treasury bonds. During times of economic stress, credit spreads can widen dramatically with a corresponding impact on returns. During the global financial crisis, credit spreads widened to nearly 20 percentage points, which corresponded to a 35% drawdown for the high-yield index. When the pandemic impacted global markets in March of 2020, spreads widened to about 11 percentage points, resulting in a drawdown of 19%. CDX's goal is to participate in high-yield asset class returns while adding hedges to assist during periods like this. But are there any issues with traditional methods of hedging? Hedging high-yield bonds can be somewhat problematic. Traditional hedging techniques involve strategies such as buying high-yield credit default swaps or put options on high-yield ETFs. These strategies are expensive and can result in a significant drag on returns. More importantly, they would serve to cancel out the exposure to the high-yield credit factor, effectively bringing the portfolio closer to the risk-free rate, which defeats the purpose of owning high-yield bonds. CDX seeks to avoid these hedging issues by taking on a totally different approach to hedging. Here's how the portfolio is constructed. Portfolio construction begins by obtaining nearly 100% exposure to high-yield bonds by investing in total return swaps tied to the returns of a high-yield ETF. The primary hedging vehicle is a pair of equity swaps, which represent a long basket of quality stocks plus a short basket of junk stocks. Occasionally, the fund may add additional hedges such as equity put options or credit default swaps, but only when they are priced attractively. Now let's discuss these components in greater detail. The exposure to high-yield bonds is obtained by investing in total return swaps linked to the returns of a high-yield ETF. These instruments are liquid and easy for the fund to trade, making it more efficient than buying the high-yield bonds directly. They also provide incremental returns above that of owning the high-yield bonds directly. Let's unpack that a bit more. First, CDX takes a long position in high-yield total return swaps. The dealer from which the swaps were obtained pays CDX the total return of an underlying high-yield ETF plus a security lending fee, earning CDX an incremental return. Why would a dealer do this? Dealers are eager to offer this additional return because many credit funds buy individual bonds while borrowing and then shorting the high-yield ETF to reduce their market risk. This leaves the dealers long the ETF. Generally, dealers don't want to carry this risk on their books, so they seek to sell or hedge this exposure. CDX investors are providing a service to the dealers by taking on this exposure. Thus, a portion of the interest earned from loaning out the ETF shares to the credit funds is passed on to CDX via a favorable funding rate on the swap. The net result is that CDX benefits from some incremental returns above that of owning the high-yield bonds directly. Now let's take a closer look at the primary hedging vehicle, which is a long basket of quality stocks combined with a short basket of junk stocks. The quality basket is a long basket of about 100 stocks representing about 30% of the portfolio's value. These are companies that do not need to access capital markets or take on debt to finance their operations. They frequently display higher quality metrics such as high margins, profit stability, and balance sheet strength. The junk basket is a short basket of about 100 stocks representing about 25% of the portfolio's value. The fund screens for the highest decile of sensitivity to an increase in debt refinancing costs. Such companies may experience difficulty remaining viable, particularly in difficult economic environments. The reason the junk basket is sized slightly smaller than the quality basket is due to the junk stocks having a higher beta. Both baskets are weighted to roughly mirror the sector exposure of the high-yield credit indices, reducing the risk of unintended sector bets. The two baskets taken together are a beta-neutral hedge that has historically performed well during periods of severe high-yield drawdowns. Investors who are interested in seeing the exact holdings of the quality and junk baskets can find them updated daily on the Simplify website. If you go to simplify.us/ETFs, there's a link to download an Excel file with all of the holdings. How effective is the long quality short junk hedge? Here we see the return of the long quality short junk hedge in blue superimposed over the high-yield option-adjusted spreads in gold. Periods when high-yield spreads are rising and high-yield bonds are thus falling in price correspond to periods of positive performance for the long-quality short junk hedge. Another thing to note is that the blue line is sloping upwards. In other words, the long-quality short junk baskets not only function as an effective high-yield hedge, but they also have had a positive return over time. Contrast this with the traditional hedging methods, such as buying credit default swaps or put options, which have a negative expected return over time. Another way to assess the effectiveness of a hedge is to look at its correlation with the underlying asset. In all months from 2007 through April 2024, the quality junk baskets taken together had a negative 0.42 correlation with high-yield bonds. However, just looking at the months in which high-yield had a negative return, the correlation was more deeply negative, at negative 0.51. Finally, in the bottom quintile months for high-yield, when performance was at its worst, the negative correlation jumps to negative 0.63. This is the behavior that you hope to see in a hedge. CDX can also take advantage of other hedging techniques, such as buying credit default swaps or equity put options. The reason equity put options can work as a hedge is that equities and high-yield bonds generally have a strong positive correlation. However, these types of hedges will only be used during periods when they are attractively priced. As an example, CDX purchased a small quantity of equity put options when the VIX dipped below 13, and thus the options were extremely inexpensive. As for portfolio use cases, the most obvious use case is to use CDX to replace any existing high-yield fund, either index or active. CDX can also be added to an existing fixed income portfolio to enhance its yield and total return potential without adding an excessive amount of credit risk. Finally, for investors in private credit, CDX offers a similar return profile with superior liquidity to private investment structures. Now for some Q&A. Do CDX's hedges help protect against rising interest rates? Not directly. For example, in 2022, rapidly rising interest rates were not accompanied by large widening of credit spreads. Hedges would assist if rising rates trigger an economic slowdown, which would typically be accompanied by widening credit spreads. When would the quality junk hedge be expected to perform at its worst? The quality junk hedge is expected to lag when the economic cycle bottoms and junk enters a recovery phase. That is typically when junk stocks outperform quality stocks. At that point, the quality junk hedge may be reduced in size while the high-yield market recovers. Should investors expect CDX to move inversely with high-yield bonds when they are in a severe drawdown? No. CDX is a high-yield bond fund, and it will decline in value during a severe high-yield drawdown. The goal of the hedges is to significantly reduce the size of that drawdown. Can CDX be used to replace an investment-grade bond fund? It depends on the investor's objective. CDX has a relatively low correlation with U.S. Treasury bonds, so it might not serve the same purpose. For example, U.S. Treasuries are often helpful as a recessionary hedge, while the opposite is true for high-yield bonds. However, it might make sense to replace a portion of an investment-grade allocation for long-term investors seeking higher returns while still managing credit risk. Thanks for watching this presentation. To find out more about CDX or any other Simplify ETF, please go to simplify.us. We'd like to hear from you directly, so if you click the Contact Us link at the top of the page, you can get in touch with us directly and we'll respond promptly.